Good evening, ladies and gentlemen. This is Barry Norman on behalf of ETX, and welcome to our two-week class on Japanese candlesticks. Now, for those of you that are joining us for the first time and don't know much about ETX, we're a regulated provider, so I'm required to give you a risk warning. So let me read that and get it out of the way. Trading in the financial markets can result in the loss of the amount invested. Do not trade with funds that you cannot afford to lose, and seek advice if you do not understand the risks. All information is provided in this webinar is for educational purposes only. ETX Capital and the presenter are not financial or investment advisors, and we do not recommend any securities or instruments of any kind. Now, those of you that are joining us through an internet or a promotion and don't know much about us, ETX is a fast-growing financial services company, and we are based in London. We are physically located there. A lot of times you can see live interviews on CNN or Sky while they're in our office interviewing our analysts. We are authorized and regulated by the FCA, the Financial Conduct Authority, and we're also a member firm of the London Stock Exchange. Now, when you trade with ETX, you have many choices. If you're a novice or are looking for another alternative to support your portfolio, we offer the ETX binary options platform. It's a good place to start learning, or you can move up right away or trade just on our ETX Trader Pro, one of the most advanced online trading systems that you don't need a download at all. You just log in and trade right online, and it offers you all your needs. But if you want to get more involved and have more elaborate trading, more control over your trading, and more technical analysis, you can use our ETX MT4 platform that'll let you hook up to expert advisors to it, use the advanced charts, and you can also automate some of your own trading using the ETX MT4 platforms. So you have many choices. Just contact your account manager and he'll help you through decide what's best for you. Now, tonight's class is a two-part series. The first part today, we're just going to be learning how and what candlesticks are. Because too many people contact me all the time and say, "Oh, Barry, I'm trading from candlesticks." I say, "How wonderful. What do you know about candlesticks? Or how did you learn about candles?" They just say, "No, when I see lots of red, I know to trade something to go down. When I see lots of green, I see trade something to go up. Or if I see 3 greens and 2 reds, I make this decision." And I walk away shaking my head, because Japanese candlesticks are a trading system, a charting system that are a lot more complex than looking for reds and greens. And if you want to learn the basics of understanding the candlesticks, then they're very, very helpful. And they have very little to do with reds and greens. Now, tonight's class is being recorded. If you wish to watch a copy of this recorded version, just use the link you used to sign up for tonight's class, but you got to give it about 24 hours for the uploading, the editing, and everything to be in place. But just use that link that you used to log into tonight's class and you go right to the recorded version. Now, candlesticks are a form of charting developed by the Japanese rice traders in the 17th century. And it's been around for a long time, and candlesticks work in just about any financial market, and you can use them anywhere. The other thing is understanding what a candlestick is telling you. And one of my criticisms, especially for new traders, is these colors, reds and greens, have psychological effects on us. And in the old days, we used blacks and whites because we didn't want to spend our life drawing, coloring in candlesticks. Today, with the computerized charts, you can even have oranges and purples. You can have whatever colors you want because it's all done for you automatically. But each candlestick, each individual candle, represents a data set of the complete price action during the selected time frame. So if you're looking at a 1-hour chart, you have one candlestick every hour, and that gives you the high, the low, the open, and the close for that hour. Sounds very much like a bar chart, doesn't it? If you're looking at a 15-minute candle, it does the same thing. It gives you the high, the low, the open, and the close for that 15-minute period. Now, the difference from a bar chart to a candlestick chart is if there is a step down, and this is what I describe as a step down from the open to the close, it's considered a bearish candle. So in other words, the open was here and you close down here, it's a bearish candle, and you would fill that body of the candle in with whatever you're using for your bearish color. In the old days when it's blacks and whites, it would be black. Okay, today when it's reds and greens, it would be red. If you stepped up from the open to the close, that would be a bullish candle, and you would fill it in with your bullish color. Not very complicated. Whether it's a 1-hour candle, a 15-minute candle, a 2-day candle, a 1-month candle, same process. Now, these shadows here are known as wicks, because what we have here is we draw a line across the open, we draw a line across at the close, we put a dot at the highest price the asset went in that period, dot at the lowest price, and we connect this high and the low to the open and the close. And these lines here are considered the wicks, or sometimes referred to as the shadow. We then connect the open and the close together and fill it in, and we have that complete candlestick. Now, candlesticks are all about the length of the wicks, the size of the bodies, and the patterns they make with the candles before and after them. Very little about the reds and the greens. Now, so we have our body, and we have what's called our lower shadow or our upper shadow, or wicks. Most of us just also refer to them as wicks. Some people even call them tails. But because they're candles, we call them wicks. So the distance, you have the upper shadow, or the upper wick, and the lower shadow, or the lower wick. These are crucially important in understanding the story that a candlestick is trying to tell you. Because again, it's all about the wicks and the bodies of the candles and the story contained therein. Now, I, for one, use a bar chart for most of everything, because a bar chart has the same amount of information as the open, the high, the low, and the close. But a bar chart doesn't have a relationship with the bar before. It does, but not an interpretable one between the bars before it and bars after it. Candlesticks, on the other hand, give you vital pieces of information with the size and shape of the candle. Now, they tell a story. Each candle, each individual candle tells you a story about who is in control of the markets. And this is very important because in order to interpret price and where price might be going or price action, we have to understand the battle between the bulls and the bears. And there are 6 basic stories. They don't vary that much, but you have to understand them. So we have them, the variations on the chart to the right here. Now, what we see is the big difference is the size of the body and the length of the wicks. And I'm going to try to explain this to you in terms that we can easily understand. So we put this in terms of a game, because it is a game between the bulls and the bears. So in candlestick 1, which is a long white candle, doesn't matter whether it's 2 inches long, 1 inch long, 2 ticks long, 3 ticks long. It doesn't make a difference if it's 5 pips, 10 pips, 15 pips. It is a long white candle because a long white candle tells you the bulls were in control for most of the game. Or in a red-green system, it's a green candle. If you have equal size wicks on either side, that means the bears pulled it up a little farther and the bulls pulled it down a little lower. But the overall game was controlled by the bears, the bulls. When you have a black or a red candle, large candle, with equal size, small wicks on either side, again, that tells us the bears were in control for that session or dominated that session. When we go to example number 3 and we have small bodies, that means the body of the candle was small with fairly equal sized wicks. That starts to show us, begins to tell us there is some indecision because price started and ended fairly close with very little activity. Okay, the bulls did not dominate and the bears did not dominate. So there is very little activity. There can be a huge volume, but there's very little conviction. Then we go over to number 4. Again, we have a small body, but we have this huge shadow going down. Well, that's telling us somewhere along the line, the bears took control of the game, but weren't able to hold on to it. Okay. So imagine the bears threw the bulls threw a pass. The bears intercepted it. They were able to hold on to it, run it back a little bit of ways. But then, after the fourth down, the bulls got the bull back, and they ended up where they started. But it means that at some given point, the bears dominated that market, but weren't able to keep control. In number 5, we have the exact opposite. There, the bulls were able to take a running leap, okay, and run, but they exhausted themselves, and the bears were able to take the market back. And it doesn't matter whether it's a green candle, red candle, black candle, white candle, because what happens is we have these long wicks or these long shadows, because it doesn't matter because price between the open and the close ended up virtually the same. When we go over to number 6, we have, again, it's almost a variation of number 3. The bulls had control, were able to pull some plays out, but then the bears were able to bounce back, and they both ended up at the same place. Both had their moments of time in that session. Again, it's only for the session of that candle. So if you're looking at a 15-minute session, that's who controlled that 15-minute session. If you're looking at a one-day candle, that's who controlled for the day. Now, but don't get yourself involved or lost in the psychological response to the reds and the greens. Because if you noticed in all of these explanations, reds and greens weren't important. Okay. Because it was all about the bodies and the short bodies and long bodies, short legs and short wicks and long wicks. So basically, we're always concerned with the body because a short body means that at the end of the session or between the whole session, there was no decisive movement. Now, once you're able to tell the story about the bulls and the bears, we have to get into the formation of special or specific types of candles. Because you always have to be able to tell the story. Because knowing who controlled, or if you imagine a tug of war, who was pulling in which side of the river, how many people got pulled into the wet side or the mud, is important to be able to tell that story. But then you also have to start deciphering what that story means in a longer term movement. Okay, so we have to look at specific type candles. And one of the most popular type candles out there is called a Marubozu. Now, a Marubozu is quite unique, although it does happen quite often. A Marubozu has no wicks. So if we remember the story of candle number 1, where the bulls dominated or the bears dominated, when you get a Marubozu, it has no wicks. That means that from the very beginning of the open to the very second of the close, if it's a green candle or a white candle or whatever you use for your bullish color, that the bulls were in control from the very second that time frame opened to the very end of the time frame. So imagine if you're looking at a one-day candle, that entire day, the bulls were in control because the bears were never able to even get a little bit of a low. And it means at the end of the session closed at the high. That means at the end of the day, the end of the trading session, whether it's a 15-minute or one day, the bulls were still running. That means if the market would have kept on going, you could have expected it to keep on going up. Then the opposite is true for the bearish color. The bears took control from the very beginning of that session and had control the entire time. These candles are very, very important because it's telling you about who is in control of the market and what you can expect in the next segment. So if this was a 15-minute or 1 hour candle, you would expect the bulls to continue running the same direction they were because they hadn't exhausted themselves yet in the previous session. So it starts to tell you or starts to give you a hint about what you would expect the markets to do. Now, when you get a bullish Marubozu in the middle of a trend, if you have an upward trend and you get this Marubozu, it tells you one thing. If you got a sideways moving market or a congested market and a Marubozu breaks out, that's telling you you have the beginnings of a very positive uptrend. As opposed if in the middle of congestion or a slight or weak downtrend and you get a Marubozu, then it's telling you the markets are moving into a hardcore downtrend, a strong downtrend. So this is starting to help you predict where the markets might go. From here we go to another candle. Now, to be honest with you, spinning tops happen all the time. Marubozus don't happen that often, and when they do, they're very true to their pattern because it's very easy to say that, oh, look at that, the bulls or the bears took control and are still controlling it now. Okay. Whereas a spinning top looks exactly like it is. What a spinning top tells you is there's huge indecisiveness in the marketplace. It tells you there's weakness and a potential change or for an interruption of a trend. But you also have to be aware of where it's taking place. Because just seeing that and just saying, this is going to happen, doesn't mean anything. If it happens or develops in a well-developed trend, it might tell you something. But they happen quite often. Sometimes the bulls and the bears just burned each other out and they're taking a breather. Sometimes they're waiting for an economic event. Sometimes something, to me, it's not important. You have to recognize them, but it doesn't really help you make a decision. Now, one of the most popular and one of the most common is called the doji. Now, the doji tells you that the buyers and sellers have no idea what's going to happen. A doji is like a cross because it's got a little bit of a wick in each direction, but what do you see in the horizontal bodies? They're virtually no body. It means that the open and the close were virtually the same. Now, they can have a tiny little body because, sometimes they're a pip difference, but they're almost non-existent. And this tells you there was really no strong tug of war between the buyers and sellers. There was just total indecision and nobody did anything. Okay. Now, a doji can have highs and lows, long shadows and short shadows. They give all kinds of names for these things, but they still all come back to tell you that there is complete indecisiveness. Because we have to look at where a doji, but just like the others, where it appears in a trend. Okay. you can't just say, I see a doji, so it's going to do this. The relevance of a doji depends on the preceding trend or preceding candlesticks. After an advance or after a long white candlestick, a doji signals that the buying pressure is starting to weaken. After a decline or a long black candlestick, a doji tells that selling pressure is starting to diminish. Dojis indicate the forces of supply and demand are becoming more evenly matched and a change in the trend might be near. Doji alone, though, are not enough to mark a reversal or further confirmation, but further confirmation is warranted. Now, before we go on, let me tell you, there's lots of funny names to these things. And we're going to be talking this week and next week, especially next week, about all these patterns. And they all have really weird names. You don't have to remember what the word Marubozu, you don't have to worry about doji, you don't have to worry about spinning tops. You have to only understand how to interpret this pattern when you see it. What you call it, remembering the name, only helps you at the pub with your buddy when you're saying, I saw in the euro US dollar, about 4 and 5 o'clock, it developed into a doji. Okay. It makes you sound smart. It's hard to describe to him that you had a pattern with no tops, no opens and closes. But for you as a trader, you don't have to remember all these names. You just have to be able to recognize the pattern. So a doji is a candlestick where the open and closing prices are the same. It can take many forms. Okay. What's key is with a doji is that neither the bulls or the bears are in control. Now, when applying a doji candlestick, a good trick is to look out for a doji near the edge of a price channel. When you see a doji appear, you have to be able to analyze where it is in the present. Okay, and there's other factors you have to combine in, which we're going to talk about, but that's going to be next week. First, you have to learn what all these are and how to recognize them before you can before you can learn how to trade from them. But after a decline or a long black candle, a doji indicates that selling pressure may be diminishing. When you see a doji in the proper place, it's informative. When it's not, and you don't see it in an upward trend or a downward trend, okay, it doesn't give you much information. Okay, and the shape of the doji, okay, the body is very important, but the length of the legs isn't all that important. It just tells you who, you don't know. It could have been one trade that pushed it to that high and it came right back down. But there's all types of names for this. We have the dragonfly. We have the gravestone, because it's all based on the names that you kind of describe what you see. But again, it's not important that this had this long down or low, and then it came back, because it came right back to where it was. It's all about the body of the candlestick. Now, before we turn to single and multiple candlestick patterns, there are a few general guidelines we have to cover, because we've talked about the development of an actual candle. We've talked about the few individual shapes of candles. And now we have to start talking about candlestick patterns. Because once you understand how to put them together, you understand what the wicks are and the bodies are, you understand the standard, forms. Now we have to talk about the patterns that these candles make. Okay. So now that we have a basic idea of what candlesticks indicate with their bodies and wicks, let's cut our teeth on some simple, uncomplicated candlestick patterns. Now these are fairly common and quite likely to appear before you in normal trading sessions. So knowing instantly what they mean and taking the proper trading decision immediately could make the difference between a winning and a losing trade. Now, standalone candles or single candles that appear. I don't give much credence to a single candle. It's like a hit on the back of your head telling you to open your eyes and look. Okay. But you have to know what they are. So we have the star position. Now I've given you a couple handouts which you can just download right there on GoToMeetings, and I've given you, and these explain to you what these different patterns are and when you see them. But the star position is a candlestick that gaps up or down from the last candle. So it's said to appear like in the star position. Okay. And what it means is, what you see here is you have the high here, you have the close here, and then when the next session opened, it bounced up and stayed above that, and it looks like it's floating in a star. Okay. And the star can form other patterns depending on how big its tails are. So we have what we call shooting stars or inverted hammers. These are basically either long upper tails and in an uptrend, or in a downtrend they're exactly the opposite, but because they look exactly like what they are. Shooting stars in an uptrend, and see, these look like inverted hammers. They look like hammers. And we also have the hanging man. And again, seeing these and where they take place in the trend or price movement on a chart helps you determine what they're trying to tell you. But you can't look for them on charts until you understand what you're looking for. Now, a lot of you are going to say, well, Barry, this is a lot of stuff to look for. I could spend my entire day staring at one chart. Now, that's kind of true. But today, fortunately, we have computers. We have systems. Now, next week, I'm going to show you a couple good free systems that will just tell you when the patterns are developing. You don't have to spend hours looking at them. They'll tell you that a hammer's developed at what time, and you can see it. And that way you can then determine, because not a single pattern tells you to do something without looking at a confirming pattern and the confirming trend. So I'll show you scanning tools that will just tell you, okay, we just had a hammer develop at this asset at this candle, at this time frame, and then you can go back and take a look at it if you wish. Now, one of my favorite patterns, again, and we're talking about single candlestick patterns, and this is called a harami. Now, harami in Japanese means pregnant, and is exactly what it is. The candle, the new candle, is completely engulfed in the body of the previous candle. So in other words, we have a candle here, and it's engulfed between the open and the close. So you have this previous candle here, whether you're looking at a 15-minute chart or 1 hour chart. The new candle is finished now. So if we're looking at a 1-day chart, today is what, Wednesday? This was Monday's trading action. Then Tuesday's trading action formed this candle, and the entire high, the low, I'm just trying to get my markings up here so I can show it to you. Okay. This entire candle for Tuesday's action was contained within the body of Monday's action. It doesn't matter whether it's an uptrend or a downtrend. You didn't hear me say up or down. All you heard me say was that Tuesday's action, or Tuesday's candle, was all contained within the body of Monday's trading. Okay. That's all that I said. Now, there are many interpretations. Okay. Once you've got a harami, and a harami is simply the next candle is fully contained within the body of the previous candle. There are several, how do I want to put it, generalizations or explanations. I use a very hardcore one because haramis happen quite often. And there's a lot of interpretations that give a little bit of leeway to the word contain. To me, if somebody's pregnant, the arms and the legs aren't sticking out of them. Everything is within their body. And I use the firmest attachment definitions you can. Some people allow the high and the low to be higher, outside the body. I don't go with it. Some people don't require that the most recent signal, the harami, is either the same color as the previous day's signal or the previous 15-minute signal or the opposite. Okay. Now, this is where your interpretation gets on. Okay. And it's important to understand it because a harami is one of the most common candlestick patterns you'll come across. So it's important to recognize it, to understand what it means, and to understand its limitations. A harami is a two-session reversal pattern. It's made up of two candlesticks and implies that the price is about to turn. It is indicated by a small body of the opposite color, completely contained by the body of the previous session. This is my finite definition. It is not essential for the two candles to be of opposite colors, but this tends to give a more reliable signal. So I say, since we all want to trade by the strictest rules, because we want the best possible scenarios, this is the rule. It's made up of two candlesticks and implies that the price is about to turn. It is indicated by a small body of the opposite color, completely contained by the body of the previous session. If you don't allow any more leniency than that, you'll get less interpretable signals, but those signals will be a lot more accurate when you get them. Because a harami is a very important signal. So as you can see here, the body of the small black candle is completely within the confines of the body of the previous candle. Now, if you notice, because there's no rule about how big or small the harami has to be, or how big or small the previous candle has to be. It just must be contained inside the body. So in other words, if you're 5'2" or 5'8" and you're pregnant, it doesn't matter, that bulge is going to be between that frame. Okay. So you have the bullish harami and the bearish harami. Okay. Now you see in this chart here, in the bullish harami, what do we see? We see somebody who allowed it to the body was contained in, but the high was outside of that previous candlestick. Okay, to me, that's not an acceptable harami. Okay. Some traders wouldn't regard this as a true harami. However, its body is entirely within the previous green candle and a reversal follows. Doesn't matter. There's always reversals. Okay. Pushing the explanation is where you get in trouble. So on the bottom chart, you see a beautiful harami and you see it correctly. Just because in the top one, it looked like a harami and it did happen. You have lots of times when the markets happen to go that way. So I'll be blunt with you. A harami doesn't always live up to its hype. While it is touted as a reversal indicator, you may find yourself disappointed by its reliability. The psychology behind harami is that a possible change in sentiment may be happening. So when you define your rules very precisely, you'll find that you increase the accuracy. A small candle does not necessarily mean a strong reversal is coming. Often with a harami pattern, several days of tight range trading, referred to as congestion consolidation, will happen. Be aware of haramis and watch for what they are trying to tell you about market sentiment, but don't have blind faith in them. So what have we learned so far? We've learned how to build a candlestick. We've understood or how to read the candle. We've explained candle shapes and sizes, the formation, positions. We talked about dojis, haramis, tops and shadows, the bulls and bears, hammers and hanging men. Okay. That's a lot for one session. But now it's time to learn about multi-candlestick patterns. As I told you, there's a lot more than besides reds and greens. So we talked about the single, and this chart I put up there, I just copied from somebody, I forget who it was, that I found on the internet. But the separation is completely right. Okay. The candles are broken into three types of patterns: singles, doubles, and triples. This writer who I use here called them Lonesome Cowboys, 2 for Tango, 3 Musketeers. I call them singles, duos, and triples. That's all I call them. Now, in the singles, we talked about Marubozu, spinning tops, dojis, hammers, hangman, inverted hammers, shooting stars. These give you some information about what you might be expecting in the market. But they shouldn't be traded from because they're only single candles. So they're forewarnings. We move on to the more complicated patterns. Now, duos or doubles involve 2 candles together forming a particular pattern. So triples do the same, except they involve 3 candles. Triples are fairly accurate because they're taking into account 3 different time segments. If you're using a daily chart, it's 3 days. If you're using a 1 hour chart, it's over the 3 hours. Okay. Now they're all got funny names and funny explanations. Now I've given you several handouts. Okay, because in essence, there are 32 different patterns. There are 16 very important shapes, and they're all on those handouts I gave you. But you have to learn to recognize them. And they are all very important because the more of these that we have, the more you can recognize them. You don't have to remember the names. You have to recognize when you see this pattern. Or if you're using a scanner and a scanner tells you, oh, we have 3 black crows coming up, in whatever time segments, okay, you need to understand what the 3 black crows do and how reliable they are. So next week, we're going to talk about the different double patterns, and then we're going to talk about blending. Okay, somebody just asked me, triples, head and shoulders. Head and shoulders has absolutely nothing to do with candlesticks. Head and shoulders is a chart pattern that appears on a chart whether you're using candlesticks, whether you're using bar charts. A candlestick is a pattern. It's got nothing to do with a Japanese candlestick. Okay. Now, next week we're going to also talk about what we call blending candles. This is combining 2 and 3 candles together to come up with a scenario. But what you have to do is you have to first learn those 16 patterns that are important. So we have the bullish engulfing pattern and the bearish engulfing pattern. Okay. But before we can interpret them on a chart, you have to learn to recognize these. Because when you do doubles or triples, they're harder to spot. Okay. Then we have bullish tweezers. Now, bullish tweezers don't happen often. They're exactly like they talk about. But next week, we're going to look for them on live. Next week, we're going to actually be spending the time on live actual charts and actually using scanners. So you have to be able to recognize these as we do. Now, morning stars and evening stars, I pay no attention to. There are some patterns that you'll learn over time to give more credibility to than others. Because morning stars and evening stars are very hard to actually even see when they're happening. And I just think they're a fluke. Okay. But we're going to go over those in great detail next week. Okay. And then we're going to talk about 3 white soldiers, 3 black crows, which are very reliable patterns, which happen quite often, which give you very good tradable scenarios. And then we're going to talk about the 3 inside up and the 3 inside down, because those are very, very reliable for reversal patterns and also give you tradable signals. So next week, we're going to get ready to look at the more complicated patterns. We're then going to go look at scanners and how to use them, and I'll show you where to find free ones that'll scan and show you what to do. And then we're going to look at how we would use candlesticks to give us entry points, exit points, stop losses, and how we would look at possibly using them for trading signals. So once we've gone through the various patterns, you got to be ready to go to the trading battle with this newly acquired knowledge, and you want to be able to stop it. I am too confused with all these funny names and shapes. Can't remember them all. So we'll teach you easy ways to do this. You'd be surprised at how many free. We're not going to take anything you buy. Now, for you guys who trade on the MT4 platform, there are also easy EAs you can put on there. They're easy things to find. But no matter what charts you're using, I'm going to show you free scanners that you can have free on the market. You just go to it and it's going to tell you that you can customize and set up for the assets you're looking for, what patterns. Because like I said, there's rated patterns, rated 1, 2s, and 3s. Like I said, 3 black crows, three soldiers are very important patterns, and they are very clear signals. You may not want to recognize a star pattern. Don't want to waste your time with it. So next week, we're going to look at how you interpret them in the trends and how to understand. But you have to know, next week, we're not going back to look at the basics and the beginnings. We're going to move straight forward. So I would say that you should spend a couple hours this week using those chart patterns I gave you and start learning and getting those names and what they mean into your heads. Okay. And on that note, I'm going to say goodbye to y'all. Thank you very much for joining us today. Thank you for being part of the ETX family. I hope I gave you some basics of the beginning. And like I said, next week we're going to take this basic building blocks of knowledge and we're going to learn how to turn it into some actual trading action. So thank you very much, and thank you for being part of ETX. Have a good night. And remember, if you want to come back and watch a recording of this, it should be ready in 24 hours. Just use the link you used for tonight's class. Click on it, and it will take you over to that recording. Good night now. Bye.